Hey folks, hope you guys are all doing well. I wanted to make a quick video here updating you on something that we made a video on a few weeks ago, and we got a lot of really positive feedback on it, and I thought it might be worth making a second video on this, and that's using some very short-term moving averages to put on your risk parameters in terms of using profit targets, entry points, and even exit points. And this is these are two great they're very simple and wonderful moving averages anyone can use. And I think particularly in a time like this right now, when we're having very trending stocks to the upside. Some things are choppy, but for the most part we have a lot of things that are very extended. It helps you gain perspective and potential profit targets. So let's have a look at this. And the moving averages I'm talking about are the 8-day moving average and the 21-day moving average. And I'm actually going to quickly make this a white background. I think that makes it a bit simpler to see, I hope. And so the 8-day simple moving average is the purple line, so this one here, and then you have the 21-day moving average, which is the yellow line, and these are just annotations I drew in. So this is a stock, Zoom, ticker symbol ZM. And I'm going to have three different stocks I want to go through, and maybe we'll look at the NASDAQ 100 as well. And so what you'll notice is that it 100% of the time, at some point when a stock rallies, it ultimately does mean revert back to the 21-day moving average. That's the this yellow line. You could also use a 20-day moving average. Honestly, it really doesn't matter. Like at that point, the differences are too small. But even more so, the mean reversions to the 8-day moving average are super high probability. So even like look at, for example, at Zoom. This is just like 2 weeks ago, and I think I have to make this smaller again. Like for example, when it rose meaningfully above that 8-day moving average, it then subsequently dropped 12% in the matter of 2 days, right? To mean revert back to the 8-day moving average. So at this point, you can, I mean, this is not a recommendation, but at this point, I think the stock is certainly overextended above its 21-day, but even above its 8-day. So it's probably way overdue to mean revert in one of those to those directions. And again, if you give it enough time, and I'm not saying months, but usually sometimes it can take a couple of weeks, it'll mean revert back to certainly the 8-day and ultimately also the 21-day. Another stock I have on my radar right now that's looking very similar is TTD. You can see here, every time it mean reverts back to the 8-day moving average and the 21-day. And also, by the way, on the downside as well. So, for example, when it got very oversold below the 8-day moving average, even though it can continue for some time, at some point, it will mean revert. And I think that's important to understand. You can also use like basic like oscillators like MACD and other oversold, overbought readings with it in conjunction to kind of fine tune it a little bit more. But really the point is when something goes vertical and gets extremely overbought or extremely oversold, it'll ultimately mean revert. So you can see TTD right now is actually trading about 14% above its 21-day moving average. Another one I want to look at right now is PayPal, PYPL. And this is, by the way, this is just to be clear, this is not I'm not making any fundamental calls on these company stocks. I'm just telling you from a mean reversion perspective, this tends to happen. And you know, and not always is the mean reversion move directionally. Like you can see, for example, here in PayPal, it's one of the reasons why I'm going to show you this one. Like ultimately, you know, it got very overbought above its 8-day moving average here, but the stock didn't really drop. But the 8-day moving average at some point caught up with the stock. So this wouldn't have been a profitable trade, but it wouldn't have lost any money either. So this is just a bit of a tooltip I thought I would give you in terms of being able to gauge extreme overbought and oversold conditions in the very near term. The NASDAQ 100, even though it's trending, you can see when it pulls back to the 21-day moving average, at some point it pulls back to the 21-day. And by the way, from a trend following perspective, it's a wonderful trend following tool. In very strong trends, the 21-day moving average is a wonderful thing to, when things pull back to it, it'll mean revert. And when you break above it, you with meaningful enough volume and you know, sort of power, then you can ultimately get into a new uptrend. So anyway, folks, I hope this helps just for some perspective on a couple of simple moving averages you can use. As always, if you enjoy this, give us a thumbs up, like, subscribe, share what we do, and I'll see you guys in the next video.